Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, July 25, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And what can you say today other than the melt-up continues? We're now breaking out of the latest bullish pattern that exists on the daily chart. And what was interesting today, though, was the market was going up until about midday. And if I just bring up a 10-minute chart just to see, the peak was made right after noontime today, Eastern Standard Time. And then the market, for the most part, drifted lower for the remainder of the day. Now, I'm not going to read too much into that. It could be just profit taking. It could be anything. It's really not that significant. And certainly when we look at some of the other indexes, we'll see that the larger picture is still and remains bullish. I do find it interesting and somewhat fascinating that the market continues to push higher in this melt-up mode. There is a number where the market will ultimately get to, and that will be the end, at least for the short term. However, apparently we're not there yet. We haven't had any signs of fracturing in this market, no reversal signals, no anything in terms of a signal that would tell us the market is ready to change character. That's not what's happening. What's happening is, even as it relates to, for example, Google earnings, and you would think the market, and generally does, take a cue off of earnings from the large tech companies or the large widely held companies. Obviously, Google is one of them, and why not just bring up a Google chart real quick? As you can see, Google finished the day down about $29, and that's an interesting move. It's only 3%, but it still generally would somewhat jolt the market, and the market basically brushed it off. And the market is brushing off some of the other earnings announcements where companies may have hit their number, or missed their number, yet the market is basically ignoring it. It's they ignore the bad news, or good news is bad news is good news. All news today is good news or positive news or being ignored, sending the market higher. We've been here before, and generally speaking, the market is intent on reaching a certain number, and what that number is will be determined when we get there and we have a reversal. That's the only way that we're going to A, identify, and B, take a signal that the market is changing character. Until and unless that happens, we let the market ride up. We certainly respect the trend. The trend is higher, and the trend is your friend until the very end. By the way, those of you interested in trading Google, if there are any out there, one of these was today's gap level, 950.02, that I was willing to play if it got there. However, 940 is really the number. Let me explain why. And I'm not really giving a lesson in Google. I just want to explain something that is interesting on the chart that I think can benefit everybody, regardless of what chart it is. When I look at this pivot low, and obviously the recent high up here, and I look at where the pivots are down here, this pivot and these pivots down here, that's telling us that that price level where those pivots occurred is important. The market found support 1, 2, 3, a little bit of a pierce through, 4 times. That's at around the 940 level. The 75% retracement comes in slightly below that, probably $1.50, $2 lower than that. And if I look at this chart, I say that around the 940 level, maybe it's within a couple of dollars. When you're looking at a $1,000 stock, $2 is really not that big of a deal. So in this neighborhood, my expectation would be that the market will find support once again based on these prior pivots. These prior pivots are telling us that that price level on the chart is important. When you couple that or marry that together with the fact that it's a deep retracement, for example, a 75% retracement, that's an area where we would be expecting a price reaction in the other direction, at minimum at an intraday basis. And obviously, it depends on how it would get there. So, for example, if the stock were to come straight in there tomorrow, for argument's sake, then you would be expecting more pronounced bounce out of that level. If the stock drifted into that level, it changes the trade. It's not the same setup. Basically, the harder and faster a stock comes into what would be and what should be a support level, the more pronounced the price reaction out of that area will and generally is. Will be. I forgot the B part of will. Okay, let's get back to business, and we'll go back over to the spider a second. I think we're pretty much done in the spider. There's not much else we can say with the spider. We're still melting up, and the next important level that I can tell on the spider is really up at 248.5, 248.25 to 248.5. So if we should trade higher, that's where I believe the next level of resistance will be. However, if you've noticed, and obviously you have, each and every time there is a resistance point in the market, it generally or has been lasting only for a day, 2, 3 days, and that's it. And then the market continues to melt higher. So I'm not interested in taking a short trade at that level, for example. I'm just interested in providing what I believe will be a solid resistance point for a minimum of an intraday reaction. But from a longer term swing trading perspective, if I'm looking for a short trade, I say it one more time, we're not doing anything of the nature, of the sort, until and unless we find a price reversal, on the chart, a signal, an engulfing candle, at minimum of a doji candle, something on high volume, a gap in crap where the market gaps higher one morning and then finishes on the lows. That's a good reversal signal on volume. Those are the type of signals we're looking for. Anything short of that, we just let the market rise. If you're long the market and long some stocks, then you just let it ride up. You ride it as long as you can, until and unless the market tells you that it's finished on the upside. That's the way it works. And believe me when I tell you, there's plenty of people out there trying to short this market at each and every turn. Every time it rises, they're trying to short the market, thinking it should come down. And eventually it will come down. Although the people trying to short the market continue to lose money time and time again because they're not waiting for the signal. We're waiting for the signal. There's no point in being the first person to the party. All we need to do is be at the party while everybody's having fun. And if we wait for the signal, we'll have plenty of fun at the party. Don't have to get the last tick on the upside. Here's the IWM, and the IWM was really powering forward today. When you look at the spider, was up 0.25% against the IWM, which was up almost 1%. That's the leading index. It's my favorite leading indicator, and the IWM was the stronger index today for sure. And quite simply, the IWM is just coming right out of this bullish pattern. We had another up move, 3 days worth of pullback, stall out and pullback, and here we are again, rising one more time. And as we know, this month's close will be extremely important for the IWM. I always bring this up, but I think it's worth looking at. When you look at this and you see where we are relative to this upsloping trend line connected by, let me just draw some circles in here, connected by these pivots here, okay? This is telling you that that trend line is important. The market drew the trend line in. Here again, we came back to rally up to the underside of the trend line, was rejected. Here we are riding the trend line, and we're slightly above it now, as you can tell, and it'll be very interesting to see where the month of July closes as it relates to this trend line. That'll be a big tell. One more glance at the daily chart, and you can see, obviously, above all the moving averages, nothing wrong with this market. It's bullish, making new highs. Let it rise. The trend is your friend up until the very end. Now, the transports were down several days in a row, and I had this flagged as a potential canary in the coal mine. And today, the transports really came out of the gate strong, much stronger than they finished. They were up about 50 more points than they finished. As you can see, we pulled back along with the other markets towards the end of the trading day, but they still finished up over 0.6%, with the IWM up almost 1% or 0.9%. These are the two leading indicators, or at least my two favorite leading indicators. So with those indexes up, the major markets up, we're taking a cue. The trend is your friend until the very end. This pullback that we saw over the last week or so in the transports may have just been a pullback, nothing more, nothing less. It's too early to tell one way or the other. We need more time. Certainly, it's possible that the transports can put in a sideways to bearish wedge pattern. That would be one of these wedge patterns that looks like this. That would promote lower prices. It's too early to tell. Right now, we're sandwiched in between the 20 and the 50 period moving average until and unless we can get above and close above the 20 period moving average. Right now, that's going to provide a certain level of overhead resistance. In addition to, when you look at these pivots over here, okay, that's also, and coinciding with the 20 period moving average, will provide some overhead resistance to the transports. So the transports certainly aren't out of the woods. We're nowhere near new highs like we were just a week or two ago. However, we're going to watch closely and see what the leading indexes give us each and every day as far as information and clues on what the next major move in the market is going to be. And by the way, it's not lost on me. I forgot to mention it earlier. I did say yesterday that I thought that the market had some downside coming over the next 24, 48 hours. And so just to be fair, that was wrong, at least for the current 24-hour period of time. We'll see what happens tomorrow, but I thought the market looked tired. I still think it does look tired, but it doesn't do what I want it to do. The market is right 100% of the time. I just thought I saw, based on some things I was looking at on the internals, I thought I would see, or we would see, some downside coming today into tomorrow, but that didn't happen. We'll see what tomorrow brings, but the market is strong, and we're going to respect the strength, respect the trend. All right, let's go over to the gold market. We pretty much flagged this last night. We came up short of the 1260 by $1, put in a pseudo doji candle, and today we were down a few dollars in the gold market. Basically, it's working off a short-term overbought condition. We don't necessarily know whether this is going to consolidate sideways for another push higher, or is it going to come all the way down farther, even farther than the moving averages. There's a lot of room in between where we are now and these moving averages, for example, that come in at around 1235, give or take. There's some room in there for the gold market to pull back and still be in a bullish short-term trend for higher prices. So it's too early to tell, but we certainly felt, at least I felt, that we were going to run into a fair amount of resistance at the 1260 level. First, we flagged 1245. Then when we got above that, we talked about the fact that the next level of resistance was really at 1260, came up $1 short, 1259. That's close enough. And now we're pulling back a little bit. So I think we've called the gold market pretty well for the most part. Even on the way back down, we'll still find support at the 1245 level. That still remains an important number to the market. Therefore, if we got down another few dollars, my expectation is that we would find some temporary, at minimum, of support at the 1245 level. Silver, on the other hand, not quite exactly the same look as gold. The chart from a longer-term perspective looks very similar or close to the same. Although today's activity was interesting, silver finished up 0.3%. We were down quite a bit earlier, and the market recovered. I don't know if that's exactly meaningful to any large degree. I'm just noticing it, and it's interesting information, not necessarily tradable. We still, in my opinion, should find a level of resistance either where we are or slightly above where we are by a few cents. Either way, we'll see what the next few days brings. Either we get a pullback pattern that could potentially be bought for another run higher, or we get consolidation that also can be bought for another run higher. Anything below 1593 in the silver market on a daily chart closing basis, my opinion would be that we're going slightly lower than that, or maybe significantly lower than that. But if we stay above that level, I think there's more upside in silver. Looking over at crude oil, I'm actually chuckling a little bit because there was a report that comes out every Wednesday after the market close. Or Tuesday. Did I say, and I think I said Wednesday before, pardon me. It's Tuesday, at least in most parts of the world, it's still Tuesday. And after the market closes, there's a oil report, crude oil report that comes out. And I don't even know what it said. I don't care what it said. But what's interesting is that crude oil traded up to the area we talked about for quite some time. We talked about it when it was making the ABC corrective pattern. I said that that would be the level that we would find resistance at in crude oil. Now, where was that level? Well, the top end was 48.66. Okay, what's the high right now? Let me move this over so you can see it. We traded right to 48.66. I mean, you can't even make this stuff up. This is how the market works. This is how the market trades. That's where we found, at least from a short-term perspective, a level of resistance. It's not to say it can't trade higher or won't trade higher. It's just that was a level that we would trade to. It could have been 48.50, 48.40, but the top of this red candle, which is a breakdown candle, was 48.66, and we talked about that, and the market traded to 48.66. And again, this is not a crude oil lesson. This is a chart lesson. This is a market lesson. This is a lesson in the way in which markets trade, all markets, all charts, over and over and over again. And if we want to play Monday morning quarterback for a second, and this is just something you can use to your advantage into the future. You see this upsloping trend line, and we were looking for the oil market, the crude oil market, to hit that upsloping trend line again yesterday, right? And so I said it came up short. And when a market comes up short of a level, and I'm not saying this was a level that I expected the market to trade to, but I certainly wouldn't have been surprised if the market hit that trend line again. It came very close. And when a market comes close like that, I kind of expect it to hit certain levels, certain numbers. But when they come up short of certain numbers, whether it's on the upside or the downside, in this case on the downside, when it came up short, in hindsight, that's a signal, if you will, of bullish behavior. Flip it around for a second and say the market is headed towards the 200-period moving average up in this zone here. And say we're headed in that direction, and then all of a sudden during the day, the market comes up, 20, 30 cents short, whatever it is, and reverses. That is the flip side of what I just talked about. That would be a sign of weakness, because as you get close to the 200-period moving average, it's really very easy for the market to achieve and reach the 200-period moving average under those conditions. And when it doesn't, in a case like that, that's a sign of weakness. Sometimes you can flag those things in real time based on how the market's trading into a certain level and whether it puts in some kind of a doji or reversal candle, anything that would be a signal that it's changing trend or changing direction. Sometimes you only can notice it really after the fact. But I think having the information is important, and there are times when you can notice it in real time and take advantage of it, regardless of what chart it is. Doesn't have to be crude oil, as we know. And by the way, before we go on to the next chart, any close above 48.66 on the daily chart is most likely, in my opinion, a straight shot to $50, potentially even higher. In fact, slightly below $50 is a 75% retracement of the move from recent high to recent low. And what I mean by that is hit this high and this low. Right now we're at a retracement, and the next one up at 75% comes in just about 49.90, I believe, if I'm right, something in that neighborhood. I forget the exact number, but it's in that neighborhood, just short of $50. So my expectation is they can pierce through that. As they get close to 50, they should hit 50. It's a nice big round number. If they don't hit 50, remember what I said before, and they start to reverse, that could be deemed a sign of weakness unless they consolidate right underneath 50, in which case they would be consolidating to move even higher yet. Look at the collapse in the bond market. Pretty remarkable, and that's also one of the reasons why we saw a strong market today. And I didn't bring up the broker-dealer index. They were up 1.5%. and the financials were up today. And the reason is, and always generally is, because when the bond market goes down, yields go up. When yields are rising, that's positive for the banks. It allows the banks to earn more margin on the money, the spread. They borrow money at one number and they lend it at another number, and they get the spread. And when the spread widens, that's to the bank's advantage. So the bank's borrowing costs haven't moved, but yet when the bond market goes down and the 10-year and the 30-year Treasury yield goes up, you and I pay more for money, and that's where the spread is important to the bank. That's the spread widening. If you went to the bank yesterday for a loan versus today, you would get two different numbers, today being the number that was more in the bank's favor. And it's interesting that we had this very one-day throw over, I'll call it. It's not really a throw over, but of this trend line, we closed above, I think it was Friday of the 21st. Yeah, that was Friday. We closed above that trend line one time and came right back down. And look what happened. We came all the way back down. And I think today's activity is an indication of lower prices coming for bonds in the near term. I mean, what you're looking at here is a very easily identified, whoops, I forgot my tool, a very easily identified bearish wedge pattern, okay? And this is playing out to the downside. We talk about it, we discuss it, we watch it happen time and time again, not just relating to the bond market, relating to charts in general. And that's exactly what we're seeing here. Where's the next natural area of support for the bond market? Well, naturally, the next area would be the 200-period moving average, coinciding with these pivot lows down here. So in this neighborhood is where the bond market is likely headed and likely will find at least short-term support. Long and wrong the dollar, little paltry move in the dollar today, little tail candle. We'll see if it develops into anything more. I'm not going to be able to call this a bottom in the dollar. That's not exactly the type of tail candle on volume we're looking for, but nevertheless, the dollar was up a few ticks, and I'll take it. I don't know that we found low yet, but we are certainly close. And I'll say it one more time. I've said it each and every night. One more time. We should be at a very, very solid level of long-term support for the dollar. Give or take a few ticks in either direction. We're in a general area where the dollar should be finding support. However, full disclosure, long and wrong the dollar, but eventually the dollar will turn to the upside and it'll rally, and when it does, when it begins to rally from whatever number it rallies from, it generally happens quickly. And with that, it's everything I wanted to discuss tonight, so I will leave it there. I'm David Frost, and remember, it's Tuesday, not Wednesday. My strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.